This video is going to be a comparison of two different bubble periods in the markets. The first one will be the Dow Jones Industrial Average, and it will cover the period from the 20s, 1920s, this advance, and then the aftermath of that bubble and into the 30s. The second bubble will be a chart of the Nasdaq Composite Index from the 1990s and then the aftermath into the 2000s. So starting with the Dow Jones Industrial Average of the 20s, the roaring 20s, we see that there was a low here and a high here, and that encompassed the whole run, which went from about 1921 to 1929, and that advance was 504% over a period of 97 months, and what looks to be a very nice looking five-wave-ish move, which got an extended fifth wave on it. To all reasonable thought, this should have corrected if it was still in a bull market back to about this level, which would have been about a cut of 60%, 50-60%. The second bubble period that we're looking at is the 1990s, starting here and ending here in the Nasdaq Composite. And we can see this also has a similar looking pattern. It gets kind of lost in here, and then into there. And again, a reasonable correction on this would have been down to about, this level. From the 5,000 down to 1,000, so roughly 80%, because that was an important spot in there. And so now we're going to compare the two of them side by side to see what they look like. And so here we have the Dow Jones on the top, and underneath that we have the Nasdaq. And we can see the entire runs. And interestingly enough, this was a much larger run for Nasdaq than the Dow was in the 20s. But it was about the same time frame, give or take 10 months or 15 months, and a very similar looking pattern. And so these are both described as bubble markets because of the extent of the run. And now we'll look at the aftermath. And so the Dow corrected back much more than what one would have expected a stopping point here. And the whole correction was down 89% in 34 months. Below it, we see the Nasdaq, which also had a tremendous correction, but at 83.5% in 31 months. Notice the similarities here between these two, but in time and price. And actually this decline had a number of things. There were no large rallies in either one of these, although this had about a 3-month rally in here, this had a 3-month rally here, and then 2 months here, 3 months here. And for the most part, these followed very similarly. The only real big difference here is this is the starting point, the ending point to the rally, starting point, ending point to the rally, and then this is just a retracement of this whole movement down, as we surmise, to about the 1,000 level more or less in this index, just retracing a portion of this advance, while this in the Dow, this corrected more than that whole advance. So this was just a retracement, while the Dow corrected beyond the point from its origin. And at this point, we're just going to slide these over a little bit so we can compare the corrections, because that's really where it pops off the page, so to speak. So we're just moving these and lining them up so we have an equivalent starting point over here And so now we have them lined up more or less in sync with these highs. And I have them marked with boxes so you can see the high and then the lows. And then the subsequent rally high and then another corrective low. What's quite fascinating is, again, this percentage decline is almost identical to this one, and the amount of time that it took to get there is almost the same as that. And then, interestingly enough, that's not where the comparison ends, because we have a tremendous advance, which pattern-wise looks like that here, and here we have a similar pattern here. The percentages are off, this being 382%, which is almost a Fibonacci 377. This is 181%, but the time frame is almost almost the same at 60 months for this and 56 months for this. So these are very similar types of retracements. I've drawn in two Fibonacci guidelines from the top to the bottom, which shows that this was about a 50% retracement of this whole decline in the Dow. And for the Nasdaq into the year 2008, 787, we had a little bit better than a 38%, but it was close to 50%, which is right there. So again, these are very similar waves on a retracement basis as well. And finally, we see that from this retracement and this retracement here, we had another decline, which in this case of the Dow was 50% in 12 months. And in the Nasdaq, into 2009, it was 54.5% in 13 months. Again, almost identical corrections, thereby tracing out what was quite a bit of time after the massive bubbles that both of these markets had. And it's fascinating that the patterns are almost identical up until that point. Obviously, the Dow was hampered further and actually came off and double bottomed here in 1942, which some say was an inflection point in the World War II, and with the Battle of Midway ending that right there. Interestingly enough, that's where the market took off in Nasdaq in the year at the end of 2012 and into 2013. So in conclusion, we're looking at two decade-long periods. The first part with a major advance, which was a bubble in both cases, in the Dow in the 20s and in Nasdaq in the 1990s. And then we have the major corrections, which were the biggest of the last 100 years in both of these markets. The Dow finishing in 1932 and Nasdaq finishing in 2002. And notice that each of these are separated by approximately 70 years as well. 2000 coinciding with this. So 1930 and 2000, and then 2002 coinciding with 1932, and then further 1937 coinciding with the 2007 high, and finally 1938.5 coinciding with 2008 and 3/4. each 70 years apart. These two patterns describe the market as recurring fractals in different time frames after two major bubbles.